Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello and welcome to India Market Outlook podcast mini-series, which outlines our key investment views and how investors should be positioned in the current market scenario. My name is Ravi Singh. I'm the Chief Investment Strategist at Standard Chartered Bank India, and I'll be your host for this podcast. Risk assets have maintained the positive momentum in the first quarter of 2024, hitting new highs supported by still resilient economic growth momentum and strong corporate earnings delivery, while the increased likelihood of global central bank policy easing in second half of this year is an additional tailwind. This continued strong performance of domestic assets does raise some investor concerns as equities continue to scale new all-time highs while domestic bond yields have eased, a stark departure from global bond yields that are making near-term highs. To help us through understanding the current market scenario better, I have with me Mr. Vinay Joseph, who heads the investment products and strategy at Standard Chartered Bank India. We've got quite a lot to cover, so let's get started. Hi Vinay, thanks for joining us today.
Hi Ravi, thanks for having me on the podcast.
First up, let's start with understanding what continues to drive the resilience in Indian asset, which seems to be continuing well into the fourth year now, and whether you see this continuing for the rest of 2024.
Well, yes, in our Outlook 2024 that we had released at the start of the year, we highlighted that India's robust macro fundamentals and strong corporate earnings cycle positioned India assets at a relative advantage amid a very challenging global macro backdrop, given the hard landing risk that major developed economies have. This led us to suggest investors to sail with the wind by being overweight equities, which in our view has played out quite well. Now, domestic growth remains above trend, driven by robust public capex and investment growth. Consumption demand, though muted, is showing some signs of pickup. Inflation, on the other hand, continues to trend lower, given lower commodity prices and food article prices, and core inflation easing to an all-time low. So as we go deeper into 2024, we expect this strong domestic economic growth momentum to continue, supported further by pre-election spending and improving consumption demand. Additionally, macro stability indicators continue to show improvement. We have lower import growth, robust FX reserves, and the government prioritizing fiscal consolidation while sticking to a higher public capex plan in its annual budget for FY 2025 as very strong supports.
Well, that does sound reassuring. Even the RBI and other multilateral agencies maintain a strong macro outlook for India with positive upgrades recently. Now, coming to performance of Indian assets going forward, what should investors expect?
Well, on performance, we do see it getting influenced by some key event risks which are there, not only in India, but globally. And for Indian assets, we remain cognizant of the risk to the near Goldilocks scenario, which basically means we are having strong growth with contained inflation, and we would stay on watch for any unexpected deterioration in growth outlook and hard landing risks in major developed economies. In the near term, we expect volatility to remain high as markets will respond to the evolution of following four factors which I'll enlist. The first is obviously the general elections. Since quarter 4 of 2023, Indian markets are definitely factoring in the incumbent government retaining its mandate in the upcoming general elections. This is also reflected in public opinion polls, which remains a high probability scenario. A decisive victory for the incumbent governments will definitely support these conditions which we have seen, and a repeat of 2019 performance is going to be positive for markets. But it's also important to maintain caution because history suggests that opinion polls do not take away the risk of a surprise polling outcomes, as sentiments can swing before the actual polls. 2004 Lok Sabha polls serves as a good example. On the contrary, if an NDA coalition with a weaker BJP comes into power, that could limit the government's ability to push through bold reforms, and that's also market reaction could be negative in the near term. An India alliance victory remains a tail risk, and this could definitely have an adverse shock to the market, as this outcome raises policy risk reversal and a likely moderation in capex and increased government spending on consumption, which can be in the medium term inflationary. Nevertheless, on the medium term prospects of Indian assets remain intact. India's broader macro conditions, as highlighted earlier, remains resilient amid strong growth, declining inflation, fiscal prudence, and improving external accounts. Now, the second factor which we'll have to look at is corporate earnings cycle. Now, we've seen very strong earnings momentum in the first 3 quarters of FY 2024, with Nifty EPS earnings, the benchmark index, clocking nearly 20% growth so far. As per the consensus estimates, Nifty Index's EPS is expected to grow 15% between 2024 and 25 after clocking nearly 20% growth over 2020 and 2023. Now, this 5-year cycle will be the best post 2004-2008. However, on valuations, we are definitely a bit stretched, both on absolute and relative, which leaves very little room of disappointment on earnings. So there will be key factors which we'll have to look at the earnings. One is how quickly will revenue growth improve, because that is critical for sustainability, as the best of the margin improvement is likely behind us, with the tailwinds from commodity and raw material prices slowly dissipating. The third factor is going to be RBI's policy stance. RBI has maintained a status quo on policy rate for over a year now. Since October 2023, the RBI has been very comfortable with the banking system liquidity by regularly intervening both two ways, which basically means to suck as well as put in liquidity when needed. This has ensured that overnight borrowing rates are very close to the policy rate. Now, strong domestic growth momentum reduces the need also for RBI to cut aggressively policy rates, and they can target the still elevated consumer price inflation. However, over a medium term, a prolonged period of elevated real policy rates could weigh on growth, which also is a central bank priority. So in our view, RBI will weigh very closely the incoming data and see the momentum in prices, especially on commodity prices, before embarking on policy easing. We do expect the RBI to cut rates later in the year. However, the quantum of easing in this cycle is going to be shallow. One, because the starting point is much lower. And second, we are going in a period where inflation is structurally going to be a little bit higher. The last factor which we'll have to watch is for weather-related uncertainties. Monsoon still remains very critical for India's agriculture produce, as well as inflation evolution over 2024. Earlier this year, the IMD did forecast a warmer start, and we are seeing those conditions persisting. Unseasonal rainfall, which is likely to occur in this month, also raises the risk of food inflation spike. Further, other reservoir levels, especially in southern part of the country, offer limited cushion against any adverse rainfall scenario. A normal and well-distributed monsoon would be key to tame volatile food article prices to keep inflation below or close to RBI's medium-term target of 4%. This is even despite the core inflation declining to an all-time low. So we'll have to see these 4 factors, how it evolves over the coming near term, but this would keep the markets a bit volatile.
Thanks, Vinay, for the update. Well, that's all the time we have for today. Thanks very much, Vinay, for taking time out to outline our key investment views as we head into an interesting quarter of 2024. For listeners, do reach out to your relationship manager for a copy of our latest India Market Outlook, or you could also log into our online banking at www.sc.com/in and find it in the SC Invest section. Thanks very much.
Thank you.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered relationship manager or visit www.sc.com/in.